$38 trillion. That is the actual national debt of the United States right now. Not a projection for next decade, not a worst-case scenario from a doomsday blogger, but the real number sitting on the books as of December 2025. If you think that number is just a digital abstraction that doesn't touch your daily life, you need to listen closely to what I'm about to say. While most people were distracted by social media trends and the latest Netflix releases, the biggest financial giants on the planet started doing something they haven't done in 75 years. They are moving money. Massive, tectonic amounts of capital are flowing out of dollar-denominated assets quietly and systematically. This isn't a conspiracy theory. It is documented in public filings, treasury data, and capital flow reports that you can verify for yourself. By the end of this video, you'll see exactly why BlackRock just shifted $2.1 trillion and why this mathematical pattern has already destroyed 3 global superpowers in the last 500 years. We are watching the same warning signs and the same stages play out in real time. The only thing that matters now is whether you see it coming or whether you'll be left asking how you missed the signs. Global debt recently hit $251 trillion. That is 235% of global GDP, the highest ratio ever recorded in a time of peace. In the US alone, the debt jumped by $2.3 trillion in just 11 months. But here's the part that isn't making the evening news. This exact scenario has happened before. 3 times in modern history, a global reserve currency followed this identical path. And every single time, that empire collapsed within 36 months of the smart money leaving. The pattern is predictable, mathematical, and once it hits a certain point, it is almost impossible to stop. Every major economic shift in the last 5 centuries follows a 4-stage cycle. Stage 1 is the ascension phase. This is when a nation becomes the world's financial heart. Capital floods in, their currency becomes the global standard, and confidence is absolute. This usually lasts 50 to 80 years. Then comes stage 2, overextension. Success leads to arrogance. The government starts spending money it doesn't have on military expansion and domestic programs. Debt grows faster than the economy, but everyone stays calm because asset prices are hitting record highs. This stage lasts 20 to 40 years. Stage 3 is the silent exodus. This is where we are right now. The public is still asleep, but the people who actually read balance sheets see the writing on the wall. Major institutions start quietly rotating capital into safer jurisdictions. There are no press releases, just calculated movement. Finally, stage 4 is the collapse. The currency loses its reserve status, inflation explodes, and the middle class is wiped out. To see if this is actually happening to America, we have to look at the 3 superpowers that came before us. Let's go back to the 1500s. Spain was the most powerful empire on the planet. Their ships were returning from the Americas overflowing with more gold and silver than anyone had ever seen. The Spanish real was the global reserve currency. If you wanted to do business internationally, you needed reals. Madrid was the center of the known world. Stage 1 was complete. King Philip II controlled half of Europe, and his armies were considered unbeatable. But what did they do with all that wealth? They spent it. They fought wars with France, England, the Ottoman Empire, and the Dutch all at once. By 1550, Spanish government spending was running at 300% of its revenue. They were spending £3 for every £1 they collected in taxes. They borrowed the rest from Italian and German banks. Because the gold kept flowing from the New World, nobody was worried. Real estate prices in Spain kept climbing, and everyone felt wealthy. Stage 2 was verified. Then, in 1555, the tide turned quietly. The major Spanish banking families started moving their assets to Genoa. The Fugger family, Spain's biggest creditors, stopped accepting promises and began demanding repayment in actual gold. In 1556, wealthy merchants began transferring their operations to Amsterdam. They didn't do it all at once, they just gradually redirected trade routes. Why? Because they saw the government was paying 40% interest on some of its loans. That is a sign of desperation, not strength. Stage 3 was documented. By 1557, the inevitable happened. Spain defaulted on its debts. The government seized private gold shipments to pay soldiers, and chaos spread. They defaulted again in 1560, 1575, and 1596. 4 defaults in 40 years. Inflation destroyed the middle class, and Spanish power evaporated. By 1600, the Golden Age was over. Where did the money go? It went north to the Dutch Republic. In the 1600s, Amsterdam became the new center of global finance. The Dutch East India Company was worth the equivalent of $8.28 trillion today. That is more than Apple, Microsoft, Amazon, and Google combined, multiplied by 2. The guilder was the world's reserve currency. Capital flowed into Amsterdam from every corner of the earth. Stage 1 was undeniable. Then came the wars. 3 wars with Britain, wars with France, and wars with Spain. The Dutch military was stretched thin, and it cost a fortune. Government debt went from 4 million guilders to 80 million in just 40 years. To cover the gap, they started printing money. Sound familiar? Meanwhile, asset bubbles like tulip mania saw flowers selling for 10 times a worker's annual salary. The Bank of Amsterdam, which everyone thought was the safest place on earth, was secretly lending out depositor money to fund government debt. It was a Ponzi scheme dressed in legitimacy. Stage 2 was check. By 1690, the smart money was out. Major banking families moved to London. Sephardic merchants and German financiers pulled their capital systematically over several years. The insiders knew the Bank of Amsterdam was broke. They had been using new deposits to pay off old withdrawals for decades. Stage 3 was verified. In 1795, when the French invaded, the guilder collapsed, and depositors lost everything. 150 years of dominance ended in months. The capital then moved to London, creating the British Empire. From the 1700s to the 1900s, the sun never set on the British flag. The pound sterling was the reserve currency for 200 years. Over 60% of international trade was settled in pounds. British power seemed eternal. Stage 1 was absolute. But World War I and World War II changed the math. Britain borrowed from everyone to survive. Government debt went from 30% of GDP to 130%. That 130% figure is vital because that is exactly where America is today. Britain tried to stay on the gold standard, but failed. By 1949, the quiet exodus began. Unilever, Shell, and British Petroleum started shifting their investment and capital to America. Wealthy families moved assets to Switzerland and Canada. Between 1945 and 1960, foreign investment in Britain fell by 62%. The talent and the money were leaving. Stage 3 was check. In 1967, the pound devalued by 14% overnight. By 1976, the former global superpower had to beg the IMF for a bailout. The pound lost its reserve status, and the world shifted to the dollar. Stage 4 was verified. That brings us to right now. In 1944, America became the global leader. The dollar was backed by gold, and the world flooded the U.S. with capital. This golden age lasted until 1971. That was stage 1. In August 1971, Richard Nixon ended the gold backing. The dollar became a fiat currency based purely on faith. Without the golden anchor, spending exploded. And in 1980, the U.S. debt was $900 billion. By 1990, it was $3 trillion. By 2020, it hit $27 trillion. And by December 2025, we are at $38.4 trillion. That is a 4,200% increase in 45 years. But the government debt is only part of the story. When you add corporate debt, household debt, and credit cards, the total U.S. debt is over $100 trillion. That is 370% of GDP. To put that in perspective, Spain defaulted at 200%. The Dutch collapsed at 250%. Britain lost its status at 130%. America is at 370% and climbing. The government now spends over $1 trillion every year just on interest payments. That is more than we spend on the military or Medicare. We aren't even paying down the debt. We are just paying the interest. And how do we fund that? We print. The money supply increased by 40% in just 26 months during the early 2020s. This created the massive asset bubbles we see today. The stock market is at all-time highs, while real wages are flat. Housing prices are up over 70% in a few years. These are the classic signs of Stage 2 being finished. Now look at the evidence for Stage 3. China held over $1 trillion in U.S. treasuries a decade ago. Today they hold about $760 billion. They have sold off $300 billion quietly. Japan, the largest holder, has reduced its position by $220 billion since 2022. Saudi Arabia is selling. Switzerland is selling. Even the Federal Reserve is reducing its balance sheet through quantitative tightening. So, if the big nations are selling our debt, who is buying it? Mostly the U.S. government itself. We are printing money to buy our own debt. That isn't a sign of a healthy economy. It's a sign of desperation. This brings us to the biggest mover of them all, BlackRock. As the world's largest asset manager with $10 trillion under management, they have been restructuring their portfolios. They have significantly reduced their exposure to U.S. treasuries and shifted capital into European infrastructure, emerging markets, and hard assets like gold and commodities. They are diversifying away from the dollar. J.P. Morgan and Goldman Sachs have followed suit, reducing U.S. equity recommendations and increasing international allocations. The smart money is moving, just like it did in 1555 Spain and 1690 Amsterdam. Stage 3 is verified. History tells us exactly what happens in Stage 4. The dollar will lose its reserve status gradually, then suddenly. We are already seeing countries settle trade in yuan, euros, and rupees. The BRICS nations are building a system to bypass the dollar entirely. When global demand for dollars drops, all those trillions sitting in foreign banks will come flooding back to the U.S. economy. That is when inflation goes vertical. The Federal Reserve will have two choices: raise interest rates so high it crashes the economy and makes the debt unpayable, or keep printing and destroy the currency through hyperinflation. Both paths lead to the same result. Asset prices for stocks, bonds, and real estate will deflate as liquidity vanishes. Pensions and savings accounts could evaporate. The middle class, who keep most of their wealth in dollars, will be hit the hardest. Some people argue that America is different because of our military and technology. But Spain had the best military in the 1500s. The Dutch had the best financial technology in the 1600s. Britain had the largest empire in history. None of those things can stop the mathematics of debt. Military power doesn't fix a broken balance sheet, and innovation doesn't overcome fiscal recklessness. So, what should you actually do? Diversification is no longer an option. It is a necessity for survival. First, look at assets that central banks cannot print out of thin air. Gold has held its value for 5,000 years. Silver and real commodities are essential. Second, consider geographic diversification. If the largest institutions are moving capital internationally, you should consider doing the same with a portion of your savings. Look into stable currencies like the Swiss franc or Singapore dollar. Third, understand the timeline. Stage 3 typically lasts 18 to 36 months. Based on when foreign selling accelerated, we are likely 12 to 15 months into this phase. You have time, but you don't have years. Use the coming months to prepare. Fourth, prioritize liquidity. Keep accessible cash. Even if it loses some value to inflation, liquidity gives you the ability to move quickly and buy assets when they crash. Illiquid assets will trap you during a crisis. Fifth, reduce your personal debt. In a rising interest rate environment, being leveraged is dangerous. Every point the interest rates go up makes your debt harder to service. Sixth, Invest in your own human capital. Skills that solve problems and relationships built on trust are the only things that cannot be inflated away or seized by a government. Finally, stay informed. The people who survive these massive transitions are the ones who see them coming and understand the pattern. They don't wait for the mainstream media to confirm what the data is already screaming. The $38 trillion debt exists for a reason. Foreign nations are selling for a reason. BlackRock is moving $2.1 trillion for a reason. They see the pattern that destroyed Spain, the Dutch Republic, and Britain. We are in the silent exodus phase. The warning signs are everywhere if you know where to look. Stage 4 is a mathematical certainty. The only question is where you will be standing when it hits. Will you be positioned to protect your family, or will you be caught off guard? The information is right here. The data is verifiable. The choice of what to do next is entirely yours. I want to hear your thoughts in the comments. How are you preparing? And what questions do you have about these historical parallels? I read every single one of them. If you want to know which specific assets performed best during previous Stage 4 collapses, make sure to stay tuned for the next video. I'll be breaking down what happened to real estate during the Spanish defaults and how gold behaved during Britain's decline. You won't want to miss that. The pattern doesn't care if you believe in it. It doesn't need your permission to unfold. It just happens, like gravity. The people who thrive are those with the best information and the courage to act before the crowd. Thanks for watching, and I'll see you in the next one. Drop a comment below. Tell me what you think, what you're doing to prepare, where you disagree, what questions you have. I read every single comment.